Japan comes out swinging. 3 major interventions to prop up the yen in less than a week, and JPY is still falling anyway. They had managed to push up the currency as far as 152, which, if you recall, that was the level at which they threatened intervention in the first place. Yet, as of last check, the exchange value is 155.55 and still moving lower. Why? As I keep saying, it's fundamentals, not interest rates. To show you what I mean and what it means for everyone not in Japan, we're going to look at these fundamentals from the perspective of the energy market. After all, petroleum is a huge reason for JPY in the first place. Japan needs dollars to buy almost all of its energy, and dollar means exchange value, which is the Eurodollar surcharge. The higher the Eurodollar surcharge, the more that's not good for Japan or really anyone else. CNY down equals bad. Same thing here. But first, let's go back and review where JPY was and where it came from and where it is now. If you recall, back on April 29th, the government intervened after the currency had threatened to fall below 160 to the dollar. Then there was another intervention because the initial aftermath of that first intervention, currency started to weaken all over again. So on May 1st, there was another suspected intervention, but we all know it's taking place. And this is what Bloomberg wrote about it on the 1st. Another suspected intervention by Japanese authorities to support the yen, this time in late New York trading, and it ran into resistance from traders keen to keep selling the currency. Here's the funny thing about it all. As Bloomberg writes, the moves signal rising skepticism over the efficacy of Japan's possible intervention after the yen failed to hold all gains on Monday that were triggered by officials' first suspected intervention since 2022. No, the markets aren't just now becoming skeptical. That's the Western media, the central banker cheerleaders. Everything a central bank does is supposedly the biggest, greatest thing ever, yet they never seem to work outside of the short run. And traders know this. If you're a speculator, one of these evil speculators that governments are always singling out, all you need to do as soon as the government intervenes, just pull back and wait for the next one and the next one, and then go back to what you were doing before, because eventually the bureaucrats get tired, the market continues on its fundamental way anyway, so all you need to do is just wait out the interventions, which is where we seem to be right now. There was another suspected intervention on May 3rd. This one had pushed, as I mentioned in the intro, JPY up to around 152. And the Japanese government is expending an enormous amounts in order to essentially do this puppet show type of the theater. As Japan Times reported, Japanese officials may have spent some 3.66 trillion yen on Wednesday, that was the May 1st one, to pull the yen back from its near 34-year lows. That's according to Bank of Japan data that suggests what these currency flows might have been. But 3 interventions, they get up to 152, which was supposed to have been the red line to begin with, and now we're back toward 156 all over again. Nothing seems to have changed except for the amount of currency. And remember, the first intervention was like 8 trillion yen. That's the only thing that changes. The government comes in and intervenes, and fundamental picture remains the fundamental picture. Bureaucratic buying or selling of whatever assets doesn't change that. As much as they want to sell you on that idea, it isn't working. So what we keep coming back to is this question of why. What are those fundamentals? And why do they matter more than central bankers, which are supposed to be the center of every financial and monetary universe? Well, according to mainstream theory, JPY is moving lower because of interest rate differentials. The Federal Reserve is somehow more hawkish because it's going to cut rates a little bit later than everybody thought. And now, of course, that's under question too. And now the treasury yields are moving lower. The currency, Japan's exchange value, is still moving lower anyway. It seems like it's almost uncorrelated at this stage with this idea of interest rate differentials. And even today, late last night or earlier today, Tokyo time, Bank of Japan Governor Ueda sounded like he had gotten a phone call from the government and said, you better say something hawkish and aggressive about the yen. As Ueda was reported to have said, Abrupt and one-sided weak yen moves raise uncertainties and are negative for Japan's economy and undesirable as, for example, they make it hard for companies to formulate their business plans. Now, it appears, as this report shows, the governor seems to have adjusted his tone on the yen after meeting with Prime Minister Fumio Kishida on Tuesday. The talks generated speculation Ueda may have been asked to stick to a tougher line on the currency after comments he made last month fueled further yen selling. And yet the yen is weaker anyway. We've got hawkish Ueda talking about, hey, this currency exchange value is not something we look forward to, not something that we're looking for. Maybe the implicit threat that the Bank of Japan will be even more hawkish and maybe even consider the yen when considering whether or not to hike rates. And it doesn't make any difference. So the fundamental case for Japan's yen starts with the Eurodollar as well as the global system. It's not strictly about Japan or the yen. It's the Eurodollar. It's a global reserve currency system and how that system is functioning and how it views these individual parts of the system in any given moment in time. Japan has an enormous energy problem, an energy deficit that it has to meet only through importation. So we can tell a lot about all of these fundamentals by how much energy the Japanese are importing and how much they're forced to pay for those imports. Because remember, economies are largely price inelastic when it comes to energy. The price of oil, for example, will go all over the place, back and forth, up and down. As long as the economy is growing, it will continue to demand more oil regardless of the price. So if you see oil demand, or in this case, oil imports going down, that's a very clear sign the economy is suffering. Not growing, suffering. So when we look at the Ministry of Finance statistics on Japanese imports of crude oil, what you see is that by volume, and that's the key here, by volume, Japanese oil imports were largely stable in the middle 2000s up until around the fiscal year that ended for 2007, so March of 2008. So this makes perfect sense. As Japan and the rest of Asia goes into their part of the great so-called recession, obviously oil demand in volume tails off, it goes down. Up until that point, the Japanese had been paying more in yen to buy basically the same amount of crude oil because the global price of oil had gone up. But as we know, and we'll see in just a moment, from the yen's perspective, the exchange value of the yen was going up, which meant the Eurodollar surcharge was not all that big. In fact, there was no surcharge, and I'll get into that in just a moment. But then after 2008, Japanese oil imports by volume were steady, but at a weaker level. So at least they weren't still falling after 2008, but on the same token, they weren't really rising either, which suggested the Japanese economy, for all the promise that was focused on Asia at the time, the Japanese economy was sort of a warning here. Because the primary thesis was that in the aftermath of 2008, the developed world, Europe and especially the United States, they were going to enter a new normal of lower growth because of the hit they had just suffered in the global not financial crisis. But Asia, especially with China at the center, they would emerge relatively unscathed. And Japan was going to ride along the coattails for a little while on this new Asian century. But already by 2011 and 2012, as I talked about in a previous video, you could see the cracks forming. And here's a big one. As far as Japan was concerned, there was no recovery in the amount of oil, the volume of oil that they had imported in the immediate aftermath of 2008. So everything really changed after that, starting with Eurodollar number 3 around 2014. That's when China became the big issue that we still know and love today. At the same time, we saw the emerging markets become the latest victims of the Eurodollar system. The recognition that this was going to be a global paradigm shift. It wasn't going to be a new normal for the US and Europe, although it wasn't going to be a new normal for just the US and Europe. It was a new normal for everyone. China, Asia, emerging markets, and even Japan. Look at what you see in terms of crude oil imports by volume into Japan. Imports by volume start to go down, even though the global oil price is starting to crash. That's the 2014 supposed supply glut. It was more about demand than anything, because Eurodollar number 3 had wrecked the global economy. So we had an increase in supply up until that point, but it was really demand that shifted. And you could see it here just from Japan's perspective, and the fact that the volume of crude oil that they imported started falling, and it has never recovered. Since 2014, a decade now, oil imports by volume continue to go down. But then look at what happened in the pandemic period and really the post-pandemic age. Of course, oil demand went way down in 2020 with lockdowns and emergency measures all around the world. But then in 2021, oil imports only partly recover from the shock of 2020. So already that's kind of a concerning sign. Despite all of the rhetoric about a red-hot economy and a real recovery from the pandemic in 2021, it wasn't necessarily showing up in energy imports into Japan. But then prices blow way out across the globe, the supply shock, which meant that the Japanese had to pay an enormous amount more in yen just to acquire a little bit more in oil. But even compared to the pre-pandemic period, the statistics are absolutely astounding. For example, in the current fiscal year of 2023, after Japan suffered a recession, and of course that's a big part of it, and I'll come back to this in just a minute, oil demand and oil imports by volume are actually down in the fiscal year 2023, which puts it right back on the post-Eurodollar number 3 trend, which shows that Japan's economy, it was more of a temporary reset after 2020 than it was an actual legitimate booming recovery. And you see how it was a huge and negative change for Japan. They're importing so much less petroleum, but having to pay an enormous amount to do so, a hell of a lot more to do so. We're talking almost 50% more in yen for a lot less crude oil. That's basically the definition of being impoverished. But the difference in yen for the Japanese is how much weaker JPY was. So as the global price of crude went up over the last couple of years, there's also an enormous Eurodollar surcharge that's been added to it, which is why Japan imports so much less oil. Their economy is really suffering. At the same time, they have to pay an enormous amount for it, which only makes the economy suffer even more. So where this all begins to make sense on a fundamental perspective, on a fundamental basis, is from the perspective of Eurodollar providers. So let's go back to the 2000s, really the period between 2001 and 2011. What you see is that, of course, as I talked about in several recent videos, JPY's exchange value is moving upward, stronger, even as oil prices globally are going up, which requires the Japanese to pay more in yen for all of that imported fuel. So Japan's economy, by volume, the volume of imported oil was relatively stable. It wasn't booming, but it was relatively stable. So while that means that Japan has to pay more in yen for petroleum and energy, there's also more dollars available at the time, which is why JPY is going higher. Eurodollar providers have more dollars to provide, and they look at Japan as a relatively safe credit to provide those dollars to. Japan's economy is stable, it's close to China, why not lend them easy dollars, low Eurodollar surcharge? So even though the global price of oil goes up, there's a low Eurodollar surcharge as the yen goes up. But then it all starts to change, as I mentioned. 2011, 2014, Eurodollar number 2 becomes Eurodollar number 3, which was really centered on Asia. But really, Eurodollar number 3 was looking back and saying, there's no place to hide from this paradigm shift. The Eurodollar system is not going to go back to the way it was before. And at the end of the day, no one will be spared, including Asia and China. So as Japan's economy, which was already itself weaker in the immediate aftermath, as we can see by its lower energy component, it's fewer oil imports in the aftermath of the immediate aftermath of 2008, 2009. What that meant was, as Japan's economy itself gets weaker, it doesn't also have the support of being in close proximity to China. So oil imports start to slide, showing that Japan's economy is really contracting and suffering. From the Eurodollar provider's perspective, you've got fewer Eurodollars to provide. You look at Japan and think, This is extra risky. I need to charge a greater surcharge in order for Japan to acquire the dollars they need to then go out and buy lesser quantities of energy. And it's not just petroleum. I'll show you in a second about how it was coal as well. All of that came back in 2021. Not only is Japan's economy a mess in the post-pandemic period, global dollars are, contrary to popular belief, in very short supply. Everyone is highly risk averse in the wake of the supply shock for what should be obvious reasons today, but it's all buried under in consumer price numbers and sticky inflation rhetoric and all of that stuff. But essentially, Eurodollar providers become more risk averse in the wake of that supply shock, and they look at Japan and say, you have to borrow all of your energy and a lot of your food. You got to buy that on global markets, which means you got a huge and growing need to borrow dollars. As the global price of everything goes up, it only makes me even more nervous to provide dollars for you. So I'm going to charge you an even greater and growing surcharge to acquire dollars so that you can buy all of this stuff on global markets, which is it's so much more expensive, which is only going to make your economy even worse, which will make me even more risk averse. And round we go. So the yen tanks as oil prices surge, and Japan has to pay massive equivalent in yen for all of this energy it's importing. So the Eurodollar surcharge is essentially the risk aversion component, which is a reflection of the fundamentals as they relate to Japan, but also Japan's place in this overall global environment, this overall Eurodollar cycle, which is not a good thing. And if anything, everything got worse in 2023. It didn't get better. Japan's economy, which seemed to be maybe recovering, at least in the initial period in 2022 and 2023, when they started to remove all of the emergency restrictions, Japan's economy seemed like it was going to recover, but then abruptly hit a recession. And you're a Eurodollar provider, you look at that and think, yep, how are they going to be able to pay back all these dollar loans that they're taking out in order to buy all of this energy they're importing? It all makes sense on a fundamental basis. And the more you look at Japan's shaky situation, the higher the surcharge you're going to charge in order for them to be able to acquire dollars. And as I mentioned briefly, coal imports. So we can see the same paradigm shift in Japan's economy from the perspective of how much coal that Japan has imported. And once again, you see the same exact inflection point. Right in the years 2013, 2014, Eurodollar number 3, the volume of coal was at least steady to rising before then, and since then, it's been dropping rather steadily. So you look at that from the fundamental perspective of Japan's economy, it's another confirmation that despite all of the mainstream commentary, it's not going well in Japan, because it's not going well in Asia, because it's not going well across the entire planet. Japan is, in many ways, a representation of one of the worst cases. It's not the only one. It's on the same spectrum as everyone else, more toward the worse end. Therefore, higher Eurodollar surcharge, lower exchange value, fundamentals, not interest rates. So despite 3 large interventions from the Japanese government, markets aren't skeptical about it. The speculators stepped aside, let the government do its thing, and now they're going to go back in, along with the fundamentals that are supporting their speculative positions. JPY is getting weaker. It's not about interest rates. It's certainly not about central banks or governments at all. It's about the Eurodollar system. And the Eurodollar system is looking at Japan like the rest of the world and saying Japan is one of the worst cases around the rest of the world, but it's not exactly unique. I did a video not long ago on the history of the futility behind all of these Tokyo currency interventions over the last 15 years. You can find that at the link below. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Until next time, take care.